going to record to the cloud. And once again, welcome to all of our participants and happy St. Patrick's Day to you all. Today we are going to have an excellent presentation from Dr. Carrie Given. I'm going to turn the microphone over to Dr. Given momentarily. My name is Stephen Fox. I'm the Chief Marketing Officer at Option Hotline. And I'm going to share one screen with you momentarily. Our lawyers tell us we need to show this disclaimer before we begin. Basically just letting you know that trading involves risk. You can see our full disclaimer or any questions. Stop that screen share. And we are just about ready to get going. It's just about 3:30. When all of you logged on, you probably saw our welcome mat, and it featured the blueprint for trading success. And we hope that you all have an interest in seeing that as well. And once again, we are now ready. Happy Valentine's Day, happy St. Patrick's Day to everyone. We have our Irish presenter, Dr. Carrie Given. And Dr. Duke, if you would like to take it away, the stage is yours.
Okay, great. Thank you very much. Glad to be here today, Stephen. Thank you for inviting me. Let me
Pleasure.
get my slides up. Wait a minute here. There we are. Okay, should be able to see my title slide. Everybody okay?
Yep, we see it just fine. Go ahead.
Okay. Well, welcome everyone, and I'm glad to be with you again. I guess it was about a month ago that I spoke for Option Hotline. And at that time, I was talking about marketing hype and some of the myths in option trading that are used to sell various things and services and so forth. And this is almost like a chapter 2 of that talk in a way, because we're going to talk about some of the probabilities that we talked about in that talk. But we're also going to be looking at more, how do all these different things interact? Because what I'm going to try and emphasize is that when we come to the trading floor, so to speak, and say, okay, I want to just trade high probability trades. Well, that has a lot of implications. You don't just do that independently. It changes other factors. I've put on the slide here several of the kinds of rules that we have either heard or maybe we have said that that's how we want to trade, like placing low risk trade, low risk reward trades, or high probability trades. We're entering trades that have a low downside risk, a small risk, or just let the probabilities work in your favor. Certainly a lot of traders try and focus on time decay and gain their value via the time decay. So they're selling options and allowing them to decay. But we also know that every trade has several characteristics. Probability of success is one, the maximum gain that we can get, as well as the maximum loss. But one of the characteristics I think we often forget about, or don't realize until we're actually in the middle of it, is that all of those factors interrelate. And one of the results is, what is the expected range of these trading results? And so we're going to be talking about how these change. When we focus on high probability or low probability, that shifts these other factors. It shifts the amount of risk you're taking and what that range of results looks like. Does it go from 100% loss one day to 1,000% gain the next? Or is it something much tighter? So that's going to be the focus of this presentation. So to start with, let's review what we've talked about before about probabilities. This is the classic Gaussian distribution, named after Gauss, who was a mathematician, German mathematician, I think in the 1600s. And it's also called just a probability distribution or a normal distribution, or you'll even hear people talk about the bell-shaped curve. This particular slide I actually took from a dieting website where they had a group of men that were starting this program. And this was the distribution of their weight, which averaged about 200 pounds. So if you were to think about how to use this slide, the height at any point on this curve is the probability of the person of running into a person that had that weight. So if we get up here, say just at like 195, let's say, that probability is pretty high that we would easily find somebody in this group of men that weighed around 195. Or if you put it another way, if I were to blindfold myself and then walk into that room, the first person I touched, there's a pretty high probability that they'd weigh somewhere around 200 pounds. Well, what if we apply it to stock prices? If we do that, the current stock price is right here in the middle. I'm just going to say arbitrarily it's $200 a share. And similarly, if you go out, if you're talking about a great drop in the price of that stock, that probability is dropping the farther away from $200 we go. And we intuitively realize that. We know when we buy a stock for 125 bucks, the chance that it's going to be $80 tomorrow is very, very small. And that's why these probabilities are very small out here and out here. But how does this work out in the real world? Because oftentimes we talk about all these probabilities and theories, but what about the real world? Well, this dark curve is how it works out in actual real data. The light curve behind it is the one I just showed you, the typical Gaussian distribution. Now notice the difference. First of all, it's lower here in the middle simply because it's higher out here. Because remember, all the data has to be under this curve. So the fact that we're higher out here means that in real life, we find that there's more of these large moves higher than we'd expect from the probabilities. Same thing on the other edge. There's more of those large moves downward than we would predict just from the probability data. But in general, for the majority of the curve, it's a pretty good estimate. In other words, maybe 80–85% of the curve is accurate. So it can be a useful tool, is the point. Now this is where that probability curve was put to use first for options trading. This equation, what is known as the Black-Scholes model, was published in 1973. Now, it's not incidentally, in 1973 is when the Chicago Options Exchange opened. Because once you had this equation, it was possible to calculate a theoretical price for any option. And then you had some idea of where you were and what you ought to pay for it, etc. But the thing I want you to notice about this equation, it's obviously complicated, but notice every term has this phi. It's a Greek letter phi, and that is the probability distribution, the Gaussian distribution. In other words, the theoretical pricing of options is fundamentally rooted in the probability of that option expiring with value. Now that's a very important point, and it's something we can never lose track of. When we're trading options, we have to be aware of what the probabilities are, and we have to be sure we are paying attention to those probabilities. So let's think about some of the extremes here. Let's imagine that you're a conservative trader, and so you look at this world with options and you say, well, I want to have trades that, have an 80–90% probability of success. I'm not a cowboy. I'm not trying to risk everything. Okay, let's do that. Let's take an example of Tesla. I put this together just this afternoon when it was trading at about $680. If we went out to April, 30 days out, and bought the $500 put and sold the 520 put, now that's way below, right? We're collecting this credit of $208, and as long as Tesla stays above 520, I'm going to make my money. Now it's about one standard deviation out of the money. we have a probability. We can calculate that. In fact, if you want to do that, on my website under the free downloads tab, you'll find a probability calculator, an Excel spreadsheet where you can do that. And it has directions on the spreadsheet that explain it and what the possible uses for that are in trading. In this case, I calculated an 87% probability that Tesla is going to close above 520 and we'll get our maximum gain of $208 per spread, or 12%. But that's fine. 87% probability of success, that sounds wonderful so far. But what normally people forget about is the maximum loss. The maximum loss in this case is about $1,800 for that one spread. Now, there's a low probability of that happening. There's only 13% probability it's going to happen. So a lot of people are tempted to say, well, I'm just going to ignore that. I've got an 87% probability of success. I'm not going to worry about that. Okay, well, let's trade. Let's think about this over the long term. Let's imagine that we put on a trade like this on Tesla. We do the calculation for the standard deviation, and we position our put like this every month for the rest of this year and into next year. So every year or every month, our actual strike prices will change, but they'll always be about one standard deviation out of the money. And probably the gains will be about what you see here. We can calculate that long-term result by simply applying the probabilities, 87% times 208, maximum gain. And subtract from that the 13% probability of the maximum loss. We get a negative number, negative $52 per spread, or negative 3%. Now, this is also called the expectancy for the trade. Now, it's called expectancy because what this is telling you is that over the long term, you can expect to not make any money. So obviously, this isn't a very good idea. In other words, the pattern that you're going to see if you did this is that you'd find yourself maybe for 3 months in a row making your profit and thinking, wow, I've discovered a wonderful way to trade. And then all of a sudden, the market would take a dip and you take a big loss. But then you'd start gaining again. But what you find is that all those small gains get wiped out by these occasional, even though they're infrequent, these big losses. So high probability trading isn't the answer. So let's go the other way. Let's talk about the low probability trade. Now, this trade is never marketed as a low probability trade. It's always marketed as a low risk trade. Because after all, telling you that it's a low probability of success wouldn't sell many widgets. Same example with Tesla. Now we're going to go out to April. Now we're going up above the price, and we're going to buy a call spread, 720 to 730. Costs us $395. We have a 37% probability that Tesla will close above 730 at April expiration. Now, that doesn't sound very good, but what we're typically focused on is that gain. If this happens, we're going to make 153%. So we're thinking, wow, 150%, that's my kind of money. Our maximum loss doesn't seem that bad because we're going to make a lot of money. Well, what happens if we do the same thing we did before? Calculate our expectancy for this trade. 37% times 605 minus the 61% times the 395. Comes out almost even, slightly negative. And in either case, what's not included in these expectancy calculations are all of your trading commissions and other costs, slippage in the spread and so forth. But in this case, we have essentially the opposite pattern of trading that we saw with the high probability trade. We would have a lot of small losses, and occasionally we get this big gain, but unfortunately we'd find that our small losses just wiped it out. You can think of the ultimate low probability trade as buying a lottery ticket. Doesn't cost you much, downside's pretty small, but the probability of winning, not very good. You most likely, by the time you won something, if you counted up all the money you would use for buying tickets for the past 6 months or whatever it is probably close to being what you just won. This is the classic low probability trade. So why is this? This is kind of depressing, isn't it? This kind of says, well, you're not going to make any money at this. Well, that's exactly what it's saying, and it's exactly true. Because after all, the probabilities are included in that equation. The options are priced based on the probabilities. So what that means is that when I sell that put that's way out of the money, I don't get much money for it because there's a very high probability that it's going to expire worthless. You might buy that put that I sell because you're thinking, well, I know it's probably going to lose. You know, I'm only going to pay $5 for it or whatever. But every once in a while, that market's going to take a tumble and I'll make a lot of money. So we have two very opposite trades on each side. One has a very high probability of success, one has a low. But if the options are priced correctly, those probabilities are built into both sides of that trade. So there's no edge. There's no edge. So what I've written in red here is very, very important. And I'm amazed at how infrequently anybody points this out. And of course, I can see why. The long-term risk-adjusted returns of any option strategy will tend toward the cost of capital. Right now, that's pretty low. Less commissions and slippage. Now, that's kind of a surprising result in a way. I mean, when we build our case like we have and look at the probabilities and realize that the options are priced based on those probabilities, then we say, well, yeah, I guess this makes sense. But when you wander around the money show or Traders Expo, or you talk to people or view a lot of websites online, you don't get this impression, do you? No, you don't. So how do we make money in this business? We've got to shift the probabilities in our favor. Think about a casino in Las Vegas. Let's say you own a casino in Las Vegas. Now you're sitting there watching one of the tables in your casino, and this one guy is sitting there just winning hand after hand, got a big pile of chips in front of him. He's won $20,000. Are you upset? Are you excited? Are you wanting to throw him out? No. You're making sure he's not cheating in some way, but otherwise you're not worried about it because you have an edge in the probabilities. You know that over time, with a lot of hands, with a lot of players, that you have to win. Well, that's what we've got to do here. How do we shift the probabilities in our favor? Well, it's very simple, actually. It's called risk management. In other words, if I took that Tesla trade, either one of those Tesla trades, and said, I'm going to do this every month for the next year, if you wandered around the floor of the Chicago Options Exchange and just asked some of those market makers, told them, I have this great idea, this is what I'm going to do the first of every month, and just let it run and let the probabilities work in my favor. What do you think of that idea? They're going to tell you, I don't think much of it. You're not going to win. You're just going to end up with a small loss. It'll just kind of even out over the year. Because they know intuitively, they got it burned into their soul. These probabilities drive these prices. So we have to change this equation. Remember? We had this expectancy. But what about if we have the same probabilities, but we basically say, okay, I've got some risk management rules here. It could be a lot of things. It could be a hedge of some sort that you buy a put when it pulls back, or it could be a lot of different things. It could be just a simple stop loss. When it hits this price, I close it. But however you've decided to do it, you believe that you can limit your losses to about 200% of your maximum gain. In other words, about $400. If that's the case, and if you succeed in doing that, it shifts your equation. Now suddenly you can expect to average $127 per spread, or about 7% per trade. So you shifted the probabilities in your favor. You're now the casino instead of the poor schmuck sitting at the table. So risk management is huge. So what have we learned here at this point? We've learned that high probability trades have these frequently occurring small gains. They're relatively small gains, 5, 10%, something like that. There's a low probability of a loss happening. We like that. But when that loss happens, it's going to be huge. It's going to overwhelm all the small gains. Now, if you're focusing on the reward risk ratio, it's small, which depending on your point of view isn't very good. But your long-term risk-adjusted return or your expectancy is basically zero or negative after all the expenses. Well, then we shift over to low probability and we say, well, here we're going to have these frequently occurring small losses, but we're not losing much. So we feel better about that. Because every once in a while, we're going to have this big gain. And that's what we're wanting. We want that big winner. But by the time we get that, we've already lost enough over many losses, even though we're small individually, that it basically cancels out. So we end up in the same place. Neither type of trade, in fact, I would even take it further. Any type of options trade you can think of that you just put on and then fall asleep and wait for the probabilities to work in your favor, it won't work. It simply won't work. Every once in a while, you'll defy the odds because after all, the market is a very moving, constantly moving environment. And every once in a while, there's some options that are priced at surprisingly good prices for either the person buying or the person selling. But generally speaking, the market's very efficient. Let me introduce one other concept. You may have heard about the Sharpe ratio. This comes from a Professor Sharpe, who is a professor of finance at Stanford. I don't know if he's even still alive or if he's still on the faculty or he's professor emeritus or owns an island in the Pacific or whatever. But in any case, Sharpe came up with this idea to try and quantify the risk on investments corresponding to the return. And so his basic equation was this: take the return of whatever proposal you have, could be trading currencies, hog bellies, options, whatever. Subtract from that the risk-free return. Typically, that's the treasury bill. So if you've got a positive number here, it means that your return on investment is going to be more than just putting the money in a T-bill. Now it's divided by sigma, which stands for the standard deviation of the stream of returns that come out of that investment. In other words, I made 5% one day, next month I made 10%, next month I lost 30%, that sort of thing, that stream of returns. The standard deviation is kind of like the range from the highest to the lowest over many trades. Now, of course, if that Sharpe ratio is 0, it means that your proposal, whatever this investment is just returning what the T-bill would, so it's 0. But generally speaking, this is a positive number, and as it gets larger, sigma gets larger. In other words, as the expected rate of return goes up, the standard deviation goes up. Now, if you talk to people like some people at some firm like a Goldman Sachs that are their quant people, what they call them, they are doing calculations and watching their traders because they don't want them to take too much risk and they want to measure it. They don't want to just talk about it and say, well, this one's moderate and this one's high and so forth. No, they want a number. They want to measure it precisely and be able to control it. So they're calculating standard deviation for those streams of returns from whatever that group of stocks, options, futures, whatever it is, that one of these people at Goldman is using to trade money for some big client or a series of clients or hedge fund or whatever. Those people always track standard deviation because that's their measure, that's their quantitative measure of risk. And when you think about it, for you and I, that makes sense. If you had a account that you had no idea what your financial planner or broker was doing with it. You just told him, I'm conservative, just take care of it. And you saw the statements every month, and it generally was doing okay, but it wasn't great. I mean, it was, you'd be up a few dollars every month and sometimes be down a few dollars, but on average, you were doing well. You were making 3 or 4% a year or whatever. But it didn't change much, did it? The spread of those returns was fairly tight. That meant small standard deviation, which also meant lower risk, which is what you'd ask for. Now, you've probably seen some of these reports that come out for the hedge funds, and you've seen just the opposite. Typically, the best hedge fund will have a return in 1 year of 35% or maybe even 100%, something huge. But typically, the next year, it's a lot smaller, maybe even negative. They swing all over the place. In other words, it's higher risk. So what the Sharpe ratio quantifies is this idea. Number one, if you got a potential for higher returns, you are automatically taking more risk. Don't let anybody kid you. For example, there's one outfit out there that does a lot of options education that loves to talk about this phrase. They tell you, we will teach you how to put on high probability trades with low risk. Well, there's no such animal. Because that trade they're talking about, if it's truly high probability, it doesn't have a high return. Because they're talking about trades that make several 100%. In fact, one of their taglines on the website at one point was, when's the last time you made 300% in 3 weeks? Well, obviously you don't make 300% in 3 weeks with a low risk trade. And the other point that the Sharpe ratio makes is this volatility. What does it do to your returns? Now, let me show you some real world examples from some of the trading in my couple of my services over the past year. One of those we call the trading group. And we put on quite a few trades, 4 or 5 a month. We had 138 trades last year. Our average return was 27%. Win-loss ratio was 76%. But look at the range of returns. Several times we lost 100% on our trade. Because a lot of these trades are moderate risk, but a lot of them were trading earnings announcements. Those are probably the riskiest trades we trade. When you speculate on an earnings announcement, it's by and large, either it's a wonderful result or a terrible result. Our largest gain, on the other hand, was over 1,600%. Now, we only had one of those. All the rest of them were in triple digits. The standard deviation of that stream of results was 1.66. Now, if you look at the average of 27%, a common way in science or in the trading world to express your results for a set of data is to take the average plus or minus 2 standard deviations. Now, why is that? It's because statistically, 2 standard deviations should encompass 95% of the data. So in other words, if I'm looking for a prediction here, 27% plus or minus, in this case, 3.3, 2 standard deviations. In other words, a range from about 24% to about 30%. Now, if I'm thinking, okay, I could be making as little as 24% or maybe as high as 30% on average. In other words, that average of 27% for last year, maybe 23% next year. Now, the other thing to think about is 2020 was a great year to test your trading system for its drawdown, its maximum drawdown. The 2020 correction in March took the S&P 500 down by 35%. Our trading group was down 36% in March. So we didn't do better than the market, but we didn't do worse either. Because very often trading pattern, if you will, or a system that's taken a lot of risk, very often drawdowns are huge. So we kind of match the market in that respect. So what do you learn from this? These are lower probability trades. So we had a larger average return, 27%. That's good. But we paid for that. There was higher risk. Now, there was higher risk when you saw some of the losses, but it's also higher risk when you look at the standard deviation, because that tells you how much that return can vary. It tells you there'd be a much wider spread in the results over time. Larger drawdowns too. Now, we have another service that I started back in April of 2016 that we call conservative income. Now, this just simply uses covered calls and selling puts, all with blue chip stocks. So right now we have, at the end of 2020, we have 57 months of data. Our average monthly return over that period of time was 1.07%. Now in 2020, we made 2.95%, which was unusually high for an average monthly return. But the volatility in 2020 after that correction was huge. In some of my personal accounts that I trade very much this way, I took out 5 or 6% some months. That was my gain. I took it out and spent it. Now, normally I don't make that kind of money in a month. But last year, probability, or not probabilities, but volatilities were very high. That meant expensive options, meant you could sell options for a lot of money. But in any case, average is 0.07, 74% win-loss. The largest loss was 10.1%. And actually that occurred last year. Now the largest gain in 2020 was 8.5%. I actually went back and this wasn't quite correct. The largest gain over the 57 months was actually almost 10%. I think it was 9.5% if I remember right. So it did a little better. But last year we almost hit both extremes in 1 year, and it's not surprising. It was a volatile year. But look at the standard deviation of these results. 0.03. Remember, it was 3 points for the trading group. 0.03 here. 2 orders of magnitude difference. So we've got a long-term risk-adjusted return of 1.07% per month. And if we look at it plus or minus 2 standard deviations, that's just 0.06. So the range is pretty tight, 1.01% to 1.13%. Now, if you're really conservative, that's what you like. You don't want to be jerked around every month. You don't want to be telling your neighbor how you made 100% last month, and then at the next cocktail party over the fence, he's asking, why are you laying on your face in the yard? What happened? Now, what about the correction? Remember, it was 35%? Remember, our trading group was down even more than that, a little more than that, 36%. The conservative income service was only down 10%, which is another factor here that you have to think about when you're thinking about what kind of trading you want to do. So in this case, we had higher probability trades, which generally have a smaller return. 1% was our average monthly return. Lower risk though, small standard deviation. Now just think about it, it's 2 orders of magnitude difference. Much smaller standard deviation, much less risk. And that resulted in a very narrow spread of those results over time. And it also resulted in much smaller drawdowns. So the bottom line here, number one, is that the best trading strategy doesn't exist. Now that's blasphemy, isn't it? You'll have an awful lot of people selling trades and selling systems and selling coaching and selling all kinds of stuff, selling their books. And they don't want to hear that. In fact, shortly after I wrote my first book, which had the second chapter dealt with probabilities and came up with that conclusion you saw in one of the early slides, namely that over the long term, there isn't a positive expectancy here. Well, I was speaking at I think it was a Traders Expo out in Las Vegas, and a guy came up to me after my talk and said, I bought your book. And he said, and he was running a hedge fund, and he decided he was going to start using some options in his hedge fund. And he bought my book, and I was kind of flattered that he chose to start with that. But in any case, he read that chapter and he couldn't believe it. He thought, well, goodness, why would anybody trade this? So he came to that meeting to meet me, but he also went through the exhibit hall, and at every exhibit, he stopped and opened the book to that chapter and pointed to that conclusion and said, look at this. Is this true? And he said he didn't find a single person that told him, no, it isn't true. He found a lot of people that kind of waffled around it and said, well, we have a way of blah, 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 blah. The reality is it is true. And it's very important if you're going to trade options that you understand that at the outset. Because remember how we used risk management? That was essential to getting a positive expectancy. In other words, that's your edge. If you don't have that edge, then you might as well put your money back in the mason jar, bury it out in the backyard, and go back to bed. If you're a trader, the first, I think the most important thing you have to figure out is your personal risk profile. If you're uncomfortable with risk, you most likely are going to favor high probability trades. But do you understand that yes, there's a low probability of a loss, but that loss is going to be big. You need to know at the outset, how are you going to avoid taking that loss? Because otherwise, this isn't going to work. Now, on the other hand, let's say you're a very aggressive cowboy-like guy. You want to take risk. You ride your bicycle without a helmet. I ride my bicycle without a helmet, but that's because I'm old, and that's the way I always did growing up. I didn't understand this idea that maybe I could kill myself falling over. Still don't, I guess. But if you're willing to take more risk, you want big returns. You're wanting that big return. You want to, wow, I want to brag about my 100%, my 300% in 3 weeks or whatever. Okay, that's fine. Are you willing to take the risk it's going to take to get those returns? More importantly, can you handle those big losses? Because it won't just be big gains. There will be, just like in our trading group, there were some 100% losses. Now, another very important point, if you're of this mindset, you need to have the capital necessary to take that drawdown. If March 2020 hits again and it takes 35% of your capital away, can you continue to trade, or are you wiped out? Or have you developed some kind of hedging system so you can accommodate that loss and move on? Those are the kinds of questions that are essential. And it's that interaction that I'm trying to communicate today, because I think a lot of people get into trading and they just sort of ignore some of these relationships and just assume that they can do high probability trades and make a lot of money. Or they assume that I can do high return trades and it'll be pretty steady. I'm just going to make 25% every time I trade. No, it's not going to work that way. So hopefully I've piqued your interest. Here are some of the services that we have in Parkwood Capital. We do private and group coaching. For example, very often I will have a group course where I simply focus on income generation. We just finished one of those courses. Sometimes I do a course where we start, I call it options A to Z, where we just start with what is an option and go all the way through all of the concepts, implied volatility, et cetera, and then all the different types of trades. My weekly newsletter is $99 a month. Obviously, it comes out weekly. It's kind of a survey of the market. And then I also have trades that I send to those subscribers, typically about 1 or 2 per month. And those tend to be my most conservative trades. The trading group that I mentioned earlier is 150 a month. And that includes 2 webinars per month where you can, we go through the market. I give you my ideas about what's going on. We talk about support and resistance on a chart, what kinds of trades, that sort of thing. Goodness, what happened? You guys still there?
Yeah, we can hear you.
Oh, okay. Seems like I lost the screen for some reason.
Yeah, we got it back.
Okay, hopefully we're back. Okay. I don't know. Anyway, in trading group, we have 2 webinars a month. And in that, we talk about all the trades that we've had that month and why we did it the way we did it. The trading group, in many ways, is like a continuing education group. Almost all the people that have taken coaching from me are in the trading group because they want to continue to learn, how do you put on these trades? What's the plus and minus of this trade? How did I adjust it? Those kinds of things. And then the conservative income is the conservative type of trading, just covered calls and selling puts. And that's $99 a month. It has 1 webinar per month. Because basically in that one, we have a webinar whenever we complete a monthly expiration, and we basically cashed out all of our trades, and we talk about what stocks we're going to trade for the next month and so forth. Then the flying with the Condor is different altogether. That one, we have 2 trades on at any given time. We sell a call spread on SPX, the S&P 500 index, up far out of the money, and sell a put spread down far out of the money. And basically just adjust those as the month goes on, and we start those about 2 months to expiration. So we, at any given time, we have 1 trade. Like right now, we have a trade that will expire at April expiration, and we have another one that's on will expire at May expiration. We just closed the March one. And so that's how that service works. It tends to just stay far out of the money and try and stay out of the way of the truck, is the way I put it. And you've got my contact information there. If you'd like to contact me, I'd be glad to answer questions and so forth. And I hope we have some time left. We can take a couple questions today, maybe, Stephen.
Yes, definitely. And thank you very much for that great informative webinar. We do have one here. I was somewhat tempted to interrupt you with it because it did fit in real well with when you were talking about the stop loss, but I chose to just wait until the end here. So this is from Joseph, and Joseph asks, what if you had a stop loss rule for selling OTM options so you never hit a max loss?
Well, that's really what you want to do because, I mean, occasionally you might hit your maximum loss just because we have these major events with stocks. But if you avoid, like in our conservative income, we're selling puts out of the money. And I think it's fair to say we never have a maximum loss for one simple reason. We never make any of those trades, calls or puts, when there's an earnings announcement coming up, because that's when you get these huge moves. But occasionally you have a big move just because of some world event or whatever. But normally we don't take those maximum losses. But even when you have put in rules that you think are pretty good, you may have some kind of a weird thing happen to one of your stocks at just the wrong time. But generally speaking, the point of using, when I think about where am I going to place my stop, I'm thinking about what will my loss be when it hits that point. And I try and manage that because there's two types of risk management. One is the risk that you're taking for that one trade. So you're placing the stops so that you don't lose, etc. But there's also how much do I scale in that trade? In other words, do I do it with 1 contract, 5 contracts? And that has to do with when I figure out my stop and I say, well, if this goes against me, I think when I stop it out, I'm going to lose 500 bucks for one lot, 100 shares with 1 call or 1 put. Well, if I've got an account where the most I can ever want to lose, and I've decided this ahead of time, is $2,000 on one trade, then I would only put that one on with about 4 contracts. And so that's the kind of thing you do so that you make sure that when it hits a stop, even if it's an extreme, you aren't putting yourself out of business.
Great, thank you for that. And we have several more coming in. Next question is from Steve. And Steve asks, on high probability trades, is it possible to limit the max loss without reducing the probability of profit?
Uh, well, on average, you have to remember that when I place the trade and I put in or I calculate what the probability of the gains are, typically over time, your net probability of those gains is going to be lower, simply because that probability is for the maximum gain. And what we're going to have at the end of all of these trades is something in between. It's not going to be as high as the maximum gain that we calculated, because we're going to have some losses, just that simple. So, it's what you can look at is if you are looking at a trade that has an average, you're expecting an average percentage of 25%. Well, it's probably not going to be 10%, but it's not going to be 25% either. Likewise, if you're doing something much more conservative, where the most you're going to make in a particular trade is 7 or 8%, well, maybe it's going to be more like 5. But as you can tell, when you're doing conservative trading, you've got to be much more careful about not taking too large a loss, because you can get hurt because you're not making a lot for each of those gains. But generally speaking, your average long-term gain is going to be less than your maximum gain that you calculated for any one trade.
Great, thank you. And we have another question now, this one from William. And he asks, do your trading strategies have the same risk reward probabilities, that you have discussed? So do your trading strategies have the same risk reward probabilities that you've discussed?
Yeah, I mean, that's the reason I put our win-loss ratios up for both those services. They're both around 75%, which isn't quite a risk-reward ratio, but it's very close to that. It's basically just the number of wins divided by the number of total trades, or number of losses. And so we run around 75%, and that's an essential part of your expectancy calculation in reality. I mean, if you think about how we were doing it with the probability times a gain minus the probability times a loss, well, the relationship of that gain number with the maximum loss number is the risk reward ratio. And so if you, in general, as your risk reward ratio gets lower, let's say it's 60% instead of 75%, then your gains have to be a lot larger to compensate for that. And so it's that kind of relationship. So it does play in there. It's a little bit complicated because these things are shifting. Everything's shifting together when you change one of these. But generally speaking, my trading runs around anywhere between, I guess, 60 and 75%. I've been running closer to 75% the last couple of years. And I'm not sure if I've just been lucky or if I'm learning something, but that's where it's been running.
Outstanding. And I have at least one more question here. Looks like maybe a couple more have come in. And if you've got time, we'll keep forging ahead.
Sure.
Great. This is from initials JS, and I've read the question. Tell you what, is I will throw out a quick answer, and then you can come in with several more answers probably. This says, where do I get another explanation of services so I can follow more trades? each month. And Mr. or Ms. JS, there are several ways you can do this, and I'm sure Dr. Duke will cover it. But one way is that tomorrow you will get an email from us with a link to the recording of this very webinar. And several times, Dr. Duke has covered his services. And if I'm not mistaken, I believe many of your services are actually still up on the screen. So I don't know if you'd like to go through it again quickly, or if you'd like Mr. or Ms. JS to just go back and see the replay tomorrow. It's totally up to you.
Is the essence of the question to differentiate between these services? Is that what?
Well, or just a quick recap so that
Okay.
he or she can follow more trades.
Okay, well, let me try that. The weekly newsletter, every weekend, I write a newsletter based on that previous week's markets, basically. And I go through the S&P 500 and the NASDAQ Composite and also the Russell 2000 and go through each of those charts, look at support and resistance, and basically make comments or analyze that in terms of what are we learning and what's this look like is likely to happen in the next week. And then at the end of that, I have a conclusion basically of my trading posture, if you will, for the following week. And then also if we have a trade on at the time, because I send out a trade alert to the newsletter subscribers, it averages about 1 to maybe 2 per month. So I don't send a lot out to them. I try and send them the most conservative trades that I come across. But in any case, part of the newsletter will analyze those trades and where we stand and so forth. The trading group is quite different. The trading group is my most active service in that we have the 2 webinars per month. And I'm sending out trades probably on the order of 4 to 5 per month, I would think. Sometimes it's more than that, but something on that average. And in each of the webinars, what I'm doing is, again, analyzing the market and talking about that. But more importantly, I'm talking about those trades and why I did what I did, why did I close it, why did I open it, why did I adjust it in the way I did. And so in effect, the trading group has a lot of what I would call continuing education. Most of my coaching students have been in the trading group, and some actually have been in it for many years. In fact, I started the trading group initially. It's my oldest service, and I started it initially because a lot of my students would finish a coaching course, and they basically say to me, "You can't leave me here. I've got to continue to have some kind of help." And so that's how I started the trading group, and so that's sort of what it is. It's a continuing education, but it also allows you to put on some good trades and make some good money. Conservative income is kind of the opposite group of people that find the trading group trades a little too big or too risky. Obviously, if you can put on a trade for $300 or $400 and lose all of it, some people aren't too happy about that. And so they would prefer not to do that. And so the conservative income is a service I started actually after I started teaching the conservative income generation course. I started that in 2016. And that's when I started the conservative income service, because after teaching that course, I realized that there was a lot of my students or people that were following me that preferred that type of trading. So that's when I started that. Now that includes 1 webinar per month where we talk about the previous month, what worked, what didn't, what were our results. And then I screen a lot of stocks and I present those screens of those candidates that we're going to use for the next month and talk a bit about how those trades will go. Then the Flying with the Condor is an old service. I've had that for a long time. And that's basically, the essence of it is at any point in time, I will have 2 trades on. Both trades will be iron condors on the S&P 500 index. And so I'm going out about 1 about 1.25 to 1.5 standard deviations in each direction at about 55 to 60 days to expiration. So quite a ways out in time. Selling those call spreads up above, selling the put spreads down below. The maximum gain that's possible when I start any of those trades is typically 15 to 20%, somewhere in that range. By the time I finish, we usually don't stop or don't succeed with any more than about 12, 14%, maybe even 9%, something in that range. And so there's a lot of having to close trades, close spreads, and roll them higher to get out of the way of the market if it's moving up, or buying extra puts to hedge the downside if it's moving down. And so that's the kind of thing we do in that service. So there's not a lot of trades going on in that, but when you have an adjustment, you have to be on your toes and get my email and make it. And of course, almost all of these can be auto traded. I work with a brokerage group in Chicago that I've been working with for many years, actually, almost 10 years. And essentially you open an account with them and you subscribe to one of these services. And when they contact me and ask about your membership, I say, yes, Joe Smo is a member and he's in the trading group. And so when I send out an email to the members, putting on this Apple trade, buy this, sell that, that same email goes to this brokerage and they know that Joe is in that group. And so they put it in his account and he just tells them how much he wants invested in each trade. So he can say, I don't want to pay more than $500 for a trade or $1,000 or whatever it is. And so they manage it for him. Because a lot of my clients realize that they're just not, they're tied up in meetings all day or something like that, and they might not be able to react to a trade quickly enough. So the auto trading is actually a pretty good service. And over time, they have gotten fills very close and often better than mine. I try and set up those trades, set up the email, and then execute the trade, and then fill in the fill price and send it off to everybody, so that everybody gets it pretty quickly after I've gotten it filled. So they should be able to get something close to mine. And unless they're delayed in getting it for some reason, I didn't see it for 2 hours or something like that. But in any case, those are the various services. You can also go to my website and there's a description for each one of those services. And in the online store, when you go in there, you can see these services, what the price is, and there's a description of how they work. And also you can find under the free downloads, the track records for these services. So you can see how they did last year, or 2 years ago, or whatever.
Excellent, thank you. Next one is an easy one. It's actually a follow-up question from initials JS, whose question you were just covering. And I think you actually partially already answered this, but I'll read it to you anyway. It says, how is the trading group notified as to changes in or of the trades that they are working on?
Yeah, I just have an email distribution list. It's actually, for those of you who are familiar with it, Google has what they call their business services suite, and you can build, actually it's a service that even a large company could use, but I'm certainly not a large company, but I use it because I can easily build distribution lists that are large, a couple hundred people. And in fact, when I send out a list just to all my followers, that's about 4,000 people. So, but doing it through the Google Business Services, I don't encounter all these spam kind of problems that you have with some of the normal services. But anyway, I send out that distribution list. It goes to just an email, gets delivered within a few seconds to every member in the group or whatever the service is. And so they immediately see it and can go in and put the trade on. The email itself will have the actual details of buy this option and buy and with the strike and so forth, and sell this one, and what my result was, whether it was a debit of X dollars or a credit or whatever. And then if 2 weeks later I send you a note and say, I just had to adjust it, so I bought this one back and rolled it out to here. And again, I put all the details in. You get that within a couple minutes after I did it. And if you ever have a question, you just respond to the email and ask me. did you really mean this, or why are you doing this? And I will answer you. So that's how it works.
Makes sense. Thank you. Okay, this will be our last question. And this comes from Greg, and he asks, do you typically use defined risk vertical spreads? Parentheses, that is, outside of your conservative covered calls and selling puts. So defined risk vertical spreads.
Yes, I do a lot of those. Basically, probably the most common trade that I use in the trading group are diagonal call spreads, doing a few diagonal put spreads when the market's trending down, but generally the last few years have been diagonal call spreads. And the advantage of a diagonal call spread is that when you put it on for 500 bucks or whatever it costs you, that's the most you can lose. And as we go and roll the short call out, we're actually reducing that with those credits every week or every month. And so that defined loss becomes smaller and smaller as we go. And so, yeah, I never put on any trades that have an unlimited risk. That's just, I think that's just, well, I'm tempted to say foolish, but that sounds impolite, but it seems foolish to me anyway.
Got it. Thank you. Okay, well, that brings us to the end of the formal portion of our presentation. We thank you, Duke, very much. That was really an outstanding presentation, especially on this St. Patrick's Day. You must have had the luck of the Irish with you. So thank you again, and thank you to all of our participants. We do still have a large group on. Duke, I will take the screen back, and you are more than welcome to stay with us, or your part is done, so you're welcome to log off as well. It's totally up to you. But either way, we thank you very much again for the great presentation. And continuing on, I'd like to remind all of our participants that tomorrow, you will receive an email that will have a recap of today's webinar, a link to the video recording of the webinar, and a link to your free gift, which is Dr. Duke's Introduction to Weekly Options. That email will come to you tomorrow, and that will be in your regular email box that you get from Option Hotline. We also invite you to go back to our website at any time, and I am going to conduct brief tour of the website in just a minute or so. But we encourage you to go back to our website often and check out our upcoming future webinars. We do always have the featured next webinar shown on the website, and then we usually have at least one, sometimes two or three of the following webinars coming up after that. So once again, please visit us at Option Hotline. If you're asked to opt in, we do invite you to opt in. And with that said, I am going to take back the screen, and I am going to get us back to just the brief tour again of the Option Hotline website. We appreciate you sticking with us. We do still have a fair number of attendees with us, so thank you for sticking with us. And just quickly, I'm going to go over three of these tabs. First, the Contact tab on our website. And what we have here is phone numbers and email addresses, in most cases email addresses. For our customer support, please email us at support@Option Hotline. You can email us anytime, and chances are you'll get a quick answer. Otherwise, you'll definitely get an answer the next business day between 9 and 5 Central Time. For sales, we invite you to email info@optionhotline.com, or for Dr. Gibbons products, you can email info@marketeducation.net, or you can call Market Education at 312-858-9009. Again, that is for Dr. Carrie Gibbons products. Also, for our podcasts and webinars, if you have any questions, anything at all about something that was covered or what upcoming webinars we have, anything like that, please email us at webinars@optionhotline.com. We'll also quickly mention that we invite you to download this information on whitelisting all of Option Hotline's emails. Sometimes our emails, like anyone else's, can accidentally be put into the spam folder. If you download this information, it'll tell you how to make sure that your Option Hotline emails never go into your spam folder. Also, we have a contact card if you'd like to download that. It gives, again, all the phone numbers, websites, and email addresses that you can use to contact Option Hotline. Also, lastly, you're very welcome to reach out to any of our commentators. Dr. Duke, who gave that great presentation today. That's Carrie at optionhotline.com. Dan Passarelli, who has a webinar coming up in about 3 weeks. Dan at Option Hotline. Don Fishback, who's going to be up for a webinar later in April. That's Don at Option Hotline. And lastly, Steve Kalasian, he would be Steve at optionhotline.com. Pretty simple. And at the bottom of this page, there is also just a general message sending service into us at Option Hotline. Next, as I mentioned, we do have a webinar calendar that we invite you to check frequently. We always have the current webinar as our featured webinar. We just finished this one with Dr. Duke, Probabilities, Risk, and the Pattern of Returns. We also always have at least our very next webinar, which is going to be 1 week from today, New Trends in the New Year. That's with Keith Harwood. And then sometimes we have as many as 2 or 3 more upcoming webinars on this calendar. Most importantly, we always have all of our webinar replay videos listed. It'll give the date. It'll be a hot link, as you see. It'll feature the author who presented the webinar, and it will be a video recording just like you all just saw, featuring the author and his slides and all the information that was covered. So we have these going back a long time. So if you have any questions or you'd like to search for headlines in those webinars to see if we've covered something you're interested in, please feel free to go there. Lastly, on our About page, just very quickly, this will give you a little bit of information on what Option Hotline is all about. We also have a mission statement and a value statement. I'm going to pause for a second and allow you to read that. Okay, lastly, continuing on. This is a little bit of a backdrop on all of our commentators. Again, Dr. Duke, you just heard from. We have Carrie, Chuck, Dan, Steve, Don, and you can always read their bio and or reach out to them via the contact page. So basically, gonna leave there, and that is going to wrap it up for our webinar today. Once again, happy St. Patrick's Day. Once again, thank you very much to Dr. Duke for the great presentation. Thank you most of all to all of our participants who stayed with us. We greatly appreciate it. And please join us again 1 week from today at 3:30 Central Time, 4:30 Eastern Time for a webinar from Keith Harwood, one of our authors, our Chief Option Strategist. So thank you once again. Enjoy your evening. Take care and goodbye.